Most traders fail not because of bad strategies, but because of bad psychology and poor risk management. In this video, we will break down the powerful lessons from Trade Your Way to Financial Freedom by Van K. Tharp, a book that teaches you how to think like a professional trader, manage risk like a hedge fund, and build a system that fits you. Many people who start trading believe that the secret to success lies in finding a perfect indicator or a magical entry signal. They spend countless hours searching for a hidden formula that will predict the market's every move, only to find themselves disappointed and their accounts smaller than when they began. The truth, however, is that most traders fail not because their ideas are necessarily bad. They fail because of their internal struggles, undisciplined actions, poor management of risk. The real game of trading is not played on the charts. It is played within the mind of the trader. Good trading is about the person making the decisions. It is also most certainly about following a clear and well-defined plan that guides those decisions. This essay will explore the core lessons from Van K. Tharp's influential book Trade Your Way to Financial Freedom. His teachings shift the focus away from the endless hunt for perfect market entries and onto the things that truly matter: psychology, risk control, system development. The ideas presented are not complex or shrouded in mystery. In fact, their power lies in their simplicity. They are practical, actionable principles that any trader can learn and apply. By embracing these concepts, you can begin to trade with significantly less fear and anxiety. You can learn how to protect your hard-earned capital from catastrophic losses. Most importantly, you can start to build a solid foundation for your own personal journey toward financial freedom through the markets. For decades, traders have chased what they call the Holy Grail, a single perfect trading system that guarantees endless profits without any losses. This quest is ultimately futile because the most important and most overlooked part of any trading system is the person executing it. You are the Holy Grail, a brilliant strategy in the hands of an undisciplined, fearful, or greedy trader will inevitably lead to ruin. Your personal beliefs about the market, your ingrained habits around money, your emotional state during a trade have a profound impact on your results. If you are secretly afraid of losing money, you might cut winning trades far too early. Conversely, driven by greed or the need to be right, you might hold on to a losing trade long after your rules told you to exit. You might even add to the losing position, hoping for a miraculous turnaround that rarely comes. This is not a failure of the system, it is a failure of self-management. Therefore, the first and most critical step toward becoming a successful trader is to turn your focus inward. You must develop a deep understanding of your own psychological landscape. This means becoming an honest observer of your thoughts and feelings without judgment, recognizing how they influence your decisions in the heat of the moment. True market mastery begins with self-mastery. Think of it this way. Kasham trading system is like a high-performance race car. It might be engineered for incredible speed and precision. However, if the driver behind the wheel is distracted, angry, intoxicated, the car is not just useless, it is dangerous. The car is likely to crash. The trader is the driver of the system. To navigate the markets safely and effectively, you must learn to control your emotional state. You have to identify and challenge the limiting beliefs you hold about money, risk, your own capabilities. Trading is not a passive activity like watching a movie. It is an active performance skill, much like playing a sport or a musical instrument at a high level. Elite athletes and concert pianists do not achieve success by chance or by simply showing up on game day. They succeed through rigorous practice, unwavering discipline, and a deep commitment to following a proven process. They have pre-game routines, they study their past performances to find weaknesses, they learn from their mistakes to get better. Traders who wish to achieve consistent results must adopt this very same professional mindset and treat their trading with the same level of seriousness and dedication. A key part of this performance mindset is establishing and adhering to strict rules and routines. Just as a basketball player practices free throws every day, a trader should have a pre-market routine to prepare their mind for the session ahead. This might involve reviewing your overall trading plan, checking for major economic news, and quieting your mind through a brief meditation. It means ensuring you are well rested, properly fed, and free from external distractions that could cloud your judgment. When you approach the market with a calm, prepared mind, you are far more likely to execute your plan flawlessly rather than reacting impulsively to the market's chaotic noise. The core of trading discipline is simple. Follow your rules, not your feelings. Imagine you have a rule that states, I will exit any trade immediately if the price hits my predefined stop-loss level. During a trade, the price starts moving against you and approaches that level. Your mind might scream, it will turn around, just give it a little more room. An undisciplined trader listens to that hopeful voice. A disciplined trader, acting like a professional, follows the rule without hesitation. Every time you break a rule, you weaken your discipline and invite chaos into your results. Your trading account is the ultimate scoreboard. To improve this skill, keeping a detailed trading journal is absolutely essential. Record your entries, exits, reasons according to system, and crucially how you felt before, during, and after the trade. Many aspiring traders mistakenly believe that the key to profitability is having a very high win rate or winning on most of their trades. However, Tharp teaches a more powerful and realistic concept known as expectancy. Expectancy is a simple mathematical idea that tells you on average how much you can expect to gain or lose on every dollar you risk over a large number of trades. It reveals the true profitability of a trading system and proves you do not need to win most of the time to make a great deal of money. The formula for expectancy is straightforward. It is calculated as average win size x win rate minus average loss size x loss rate. Imagine your trading system produces the following results over your last 100 trades. Win on 40 of those trades, 40% win rate, lose on the other 60% loss rate. When you win, your average profit is $500. When you lose, your average loss is $200. Plugging in the numbers, expectancy 500 at 100x 040 200x 060, 500x 040 200. This is the profit side. 200x 060 but 120. This is the loss side. 200 1 in 20 ever 80. Expectancy OIE 80 per trade. Even though you lose more often than you win, you can expect to make an average of $80 per trade over the long run. This concept is liberating. It shifts your focus from being right on every trade to executing a system with positive expectancy. Keep losses small. Let winners run. A single trade's outcome is random and meaningless. What matters is the statistical outcome over a large series, 50, 100 more. Trust your system's positive expectancy. Trade with confidence without needing any one trade to be a winner. The math is simple. The discipline to apply it is where traders separate themselves. One of the most common mistakes traders make is trying to blindly copy someone else's trading system. A system that works wonders for a fast-paced day trader who can watch the screen for 8 hours straight will likely be a disaster for someone with a full-time job who can only check the markets in the evening. A good trading system is not a one-size-fits-all solution. It is a personal blueprint that must be tailored to fit your unique life circumstances, your financial situation, and your individual personality. The best system in the world is useless if you cannot follow it consistently, so the design process must begin with you. Start by asking yourself some simple but profound questions. What is your trading personality? Are you patient and comfortable holding positions for weeks or months? Or do you prefer the excitement of quick in and out trades that last only a few minutes? How much time can you realistically dedicate to trading each day or week? Be honest with yourself. If you are a calm, analytical person, a slow-moving, trend-following system might be perfect. If you have a high tolerance for stress and quick decisions, perhaps a short-term strategy would be a better match for your temperament. Once you have a general idea of the style that suits you, you can begin to build the specific rules of your system. Define which markets you will trade: stocks, forex, commodities. Specify your setup and entry criteria, and just as importantly, what conditions will tell you to get out of a trade, including predefined rules for taking profits and cutting losses with a stop loss. Your plan should be so clear that another person could execute it for you. Keep it as simple as possible. A plan on a single index card beats a 50-page document you never read, designed for confidence and alignment. When a system fits you, you can follow it with discipline even when emotions try to pull you off course. Section 6. The guardian of your capital, the power of position sizing. Of all the components of a trading system, Van Tharp argues that one stands far above the rest in importance: position sizing. Position sizing is the part of your system that answers the question, how much? It dictates how many shares, contracts, lots you should trade on any given setup. Many novice traders ignore this, risking random amounts of money based on how confident they feel. This is a recipe for disaster. The truth is that how much you risk on a trade is significantly more important than where you enter or exit. Proper position sizing is the ultimate guardian of your trading capital, and it is the true engine of wealth building. The primary goal of position sizing is to ensure your survival. The markets are unpredictable, and even the best systems will experience a string of consecutive losses. These are known as drawdowns. If you are risking too much on each trade, a normal losing streak can wipe you out completely, removing you from the game for good. To prevent this, professional traders use a fixed risk position sizing model. A common and prudent approach is to risk a small, predetermined percentage of your total account equity on any single trade, such as 1% or 2%. This means that no single trade, no matter how badly it goes, can ever cause catastrophic damage to your account. Let's look at a practical example. Imagine a $20,000 account risking 1% per trade, $200 max loss. You buy at $50 with a stop at $48. The per share risk is $2 position size, $200 as $100 shares. If stopped, you lose exactly $200 planned risk. Knowing your max loss is small and controlled reduces fear and anxiety, letting you focus on execution. Think in R multiples. If R is $200 and you make $600, that is a 3R win. Section 7. The scientist's approach: testing, journaling, and improving. Successful traders do not treat the market like a casino, gambling on hunches and hot tips. Instead, they approach it like scientists conducting an experiment. They develop a hypothesis, design a trading system, Rigorously test that hypothesis with data before risking real capital. This methodical process separates professionals from amateurs and builds confidence from evidence, not blind hope. The testing process typically begins with backtesting. Apply your rules to historical data to see past performance. Go back over 5 years. Simulate every trade your system would have triggered. Past performance isn't a guarantee. Berbagai testing hidupi in invaluable or IG it is a fresh step. Big testing helps identify its logic flaws, estimate win rate, average profit, and potential maximum drawdown. If a system fails historically, it is unlikely to work live. Next, forward testing. Paper or demo trading in real time. This introduces time pressure and execution realities unlike static charts. Forward testing shows if you can follow the rules in a live environment. Can you find setups and execute orders on time? The trading journal is your most important tool for continuous improvement. Record every trade, the setup, the entry, the exit, the result, your emotional state. Review weekly or monthly. Analyze expectancy. Are multiple distribution. Reasons for biggest losses. Are you moving your stop loss? Taking profits too early? Your journal will reveal the truth. Identify one weak spot at a time. Fix it. Make small, steady improvements that compound into significant progress over time. This is how you evolve from gambler to professional. Section 8. The 4 Pillars of Trading Success. A summary. The path to becoming a consistent and profitable trader can seem overwhelmingly complex, but Van Tharp's philosophy boils it down to a few core manageable principles. We can think of these as the 4 essential pillars that support the entire structure of a successful trading business. First, master yourself. Psychology drives the vast majority of success. Beliefs, emotions, and ironclad rule following. Second, build a trading system that fits you. Clear, objective rules for what to trade, when to enter, where to place your stop loss, when to take profits, aligned to your personality, lifestyle, and risk tolerance. Third, protect your capital with sound position sizing. Risk small per trade so you survive losing streaks and let expectancy compound. Fourth, test, journal, and improve continuously. Backtest, forward test, and use your journal to refine. These 4 pillars, working in harmony, create the framework for lasting success. Section 9. The Path Forward. Your journey to financial freedom. The keys are not found in secret indicators. They are found within you, forged in discipline, self-awareness, and meticulous planning. Think of trading as a serious business, not a hobby or a lottery ticket. Take full responsibility. Your results reflect your system and your ability to follow it. Start small. Do not rush. Master one skill at a time. Focus on following your rules perfectly on the next 10 trades. With unwavering discipline, a commitment to learning, and a large dose of patience, you absolutely can trade your way to financial freedom. Financial freedom is not found in signals. It is built through discipline, structure, and self-mastery.